Silver just experienced its most violent crash since the Hunt brothers tried to corner the market in 1980. On January 30th, 2026, silver plunged 30% in a single day, the worst daily drop in over 4 decades. But here is what the mainstream financial media will not tell you. Despite the rebound towards $78 per ounce, silver prices erased all of this year's gains days after reaching a record high of $121 on January 29th. If you are watching this right now, you are witnessing one of the most significant resets in precious metals history. Whether you own silver, are thinking about buying silver, or just want to understand what is actually happening in global markets, the next few minutes could fundamentally change how you see this situation. If this kind of deep analysis helps you make smarter decisions with your money, consider hitting subscribe and joining a community of investors who want to understand the real forces moving markets, not just the headlines. Let me give you the current picture with verified numbers. As of February 10th, 2026, silver is trading at $81.95 per ounce. That is up a few dollars from recent days, but still considerably below the $100 plus price it was hovering near in late January. Silver spot price on February 9th was trading at $81.13 per ounce, up $4.24 or 5.51% on the day. The volatility we have seen is extraordinary. The 52-week range for silver futures spans from $29.115 to $121.785. In the past year, the price of silver futures has changed by over 155%. Now here's where it gets interesting. Silver is currently around $30 cheaper than it was in late January after it broke the $100 per ounce record, but it is still more than double what it was a year ago. The price of silver has more than doubled from what it was in early 2025. On February 5th, 2025, the price of silver was just $32.30 per ounce. The late January 2026 high of $111.36 per ounce represented approximately a 270% increase from January 2025 levels. What triggered this historic sell-off? A wave of selling triggered higher margin requirements and magnified liquidation. Catalysts for the plunge included the nomination of Kevin Warsh for the next Fed chairman, who previously displayed strong views against a large Fed balance sheet. COMEX silver inventory plummeted to 415 million ounces, marking its lowest point since March 2025, according to the COBESI letter. This 34 million ounce drop from its peak triggered a significant short squeeze in the market. The physical market dynamics tell a fascinating story. In late January, silver contracts in China surpassed $125, while the US price was at $112. The growing price premium in Shanghai versus COMEX signals stress in global supply and confirms that physical demand in China appears to be the main fundamental driving the current trend. After the 30% silver price crash on the COMEX late on Friday, January 30th, 2026, the Shanghai silver cash price traded at a plus 29% or plus $22.98 premium to the price in Western markets. This disconnect between Eastern and Western markets is not a glitch. It is a signal. International price spread analysis indicates growing disconnection between Chinese and American silver markets. The Shanghai Futures Exchange silver contract trades at premiums exceeding $3 to $5 per ounce compared to COMEX futures, suggesting regional supply constraints. This divergence reflects China's refined silver export restrictions and accelerating domestic industrial consumption. As of February 9, 2026, the Shanghai silver price was $87.57 per ounce, according to converted prices from the Shanghai Gold Exchange. When you compare that to Western spot prices around $81, you begin to see the arbitrage opportunity that sophisticated traders are watching closely. The COMEX inventory situation deserves serious attention. As of early February 2026, reported COMEX registered silver inventory stands at approximately 103 to 113 million ounces, according to exchange warehouse reports. Total COMEX silver inventory sits at around 440 million ounces, but only about 124 million ounces are registered. That means less than 30% of the reported silver can actually be delivered. In January 2026, which is not a major delivery month, COMEX processed delivery demand totaling between 33 to 40 million ounces through the first 2 weeks, representing 26% of the registered inventory. Compare this to historical precedent where January 2025 and prior years typically saw 1 to 5 million ounces. The January 2026 figure represents a 7 to 10 times increase over historical January averages. Why does this matter? Current open interest concentration in March 2026 contracts approaches 127 million ounces, requiring approximately 23 million ounces of registered silver, assuming historical delivery percentages. For March 2026, open interest in the March silver contract represents approximately 500 to 528 million ounces notional, around 100,000 plus contracts at 5,000 ounces per contract. March is the primary delivery month, and the setup is getting tight. Now let me share what some of the most respected voices in the industry are saying. Many analysts now see a path to triple-digit silver, especially after the metal surged 147% in 2025. Gold Silver's lead analyst Alan Hibbard expects silver to trade above $100 in 2026 as supply deficits deepen and industrial demand accelerates. Hibbard stated that he is expecting silver to perform better in 2026 than it did in 2025. He would not be surprised to see the price of silver increase by over $100 per ounce to $175+. Many experts anticipate that silver will eventually march toward $200 per ounce. According to investing.com analysis, in a bullish scenario, a combination of strong fundamentals, high industrial demand, and positive market sentiment could push silver prices to $85 to $90 per ounce. But I want to give you the other side because responsible analysis demands it. Former JP Morgan strategist Marko Kolanovic, whose career stretches back 20-plus years and includes being inducted into the Institutional Investor Hall of Fame, delivered a blunt silver forecast. Kolanovic says the rally faces existential risks that will eventually lead to a bubble burst. He wrote that, unlike purely fictitious assets like NFTs, bubbles in commodities cannot last long because industry demand dries up, supply increases through recycling, and new production is hedged. Veteran trader Peter Brandt, featured in Jack Schwager's Unknown Market Wizards, also raised alarms. On X, Brandt offered a series of warnings, including one noting that recent silver trading mirrors the action at the peak of the last silver boom in 2011. He wrote that nearly 2 years of world production traded on world exchanges, more than 1.5 billion ounces, and that the last time such a proportion traded was April 25th, the day of the 2011 top. Brandt previously correctly called for silver prices to drop on April 24th, 2011. Seeking Alpha analysis from just days ago stated that at present there is a 0% chance of a COMEX default. They go over the COMEX silver default theories, revisit the 2011 price spike, and explain why today's default risk is zero. The fundamental drivers of this market are real, though. On January 1st, China designated silver as a strategic resource alongside rare earth minerals. The move restricts silver exports, requiring licenses that have become harder to get. Only 44 companies qualified for silver export licenses as China seeks to guarantee supply for next-generation solar, EVs, and electronics technologies. EV-related silver demand jumped an estimated 20% in 2025, driven by the growing use of sensors, high-voltage wiring, advanced connectors, and power management systems. AI infrastructure and data centers are emerging as a new demand vector, using silver in high-efficiency electrical components, precision contacts, and thermal management systems designed to handle extreme power loads. The supply side of the silver market is now one of its most critical drivers. Global silver supply fell from 1.07 billion ounces in 2010 to roughly 1.03 billion ounces in 2024, and remained constrained in 2025. Meanwhile, global demand reached an estimated 1.2+ billion ounces again, creating another large structural deficit, likely in the 160 to 200 million ounce range for 2025. After breaking above the resistance zone following a 120% surge in 2025, silver has entered price discovery territory. A fifth consecutive year of structural supply deficit and accelerating industrial demand support targets beyond $65. So, what is my assessment of this situation? I see silver sitting at a genuine crossroads. The fundamental case for higher prices remains intact. Industrial demand from solar, EVs, AI infrastructure, and electronics is not speculation. It is measurable reality growing every quarter. The supply deficits are documented. The Chinese export restrictions are policy fact. However, the recent crash demonstrated something critical. Silver remains extremely vulnerable to leverage unwinds and margin requirement increases. Silver jumped over 6% toward $83 per ounce on Monday, extending last week's rebound after a historic liquidation briefly erased nearly half of its value. The recovery was driven by easing U.S. inflation expectations, softer real yields, and a weaker dollar ahead of key U.S. labor and CPI releases that could reinforce expectations for Federal Reserve easing later this year. The March delivery month is the next major catalyst to watch. If delivery demands remain elevated and physical premiums in Asia persist, we could see renewed pressure on prices to move higher. If speculative positions continue unwinding and margin requirements stay elevated, consolidation or further downside is possible. As Henry Yoshida, CFP and CEO of Rocket Dollar advises, investors should watch 3 metrics that influence silver prices: real interest rates, global manufacturing activity, and the pace of renewable energy expansion. If inflation cools and rates stay high for too long, silver prices will lag. For those considering positions, understand what you are getting into. The silver futures market is far less liquid than gold, with daily London turnover roughly 5 times smaller. meaning new speculative positions have a disproportionate impact on prices. Short-term momentum traders and investors using silver as a macro hedge amplify volatility and accelerate upside breakouts. This works both ways. If you already own physical silver, the fundamentals suggest holding through this volatility makes sense for many investors. If you are looking to enter, the pullback from $121 to current levels around $82 represents a significantly better risk-reward than buying the top. But size your positions appropriately. This market moves violently in both directions. Watch the $75 level as key support. The price of silver on February 6th was $75.75 per ounce, about where the metal was hovering after falling from near $120 per ounce in January. If that level breaks, we could see tests of $70 or lower. On the upside, a sustained move back above $90 would suggest the bull market is resuming in earnest. Investors favoring allocated physical silver over paper exposure may benefit as real-world scarcity reprices the metal upward, especially if industrial demand from green technologies, AI, and medical remains strong. New demand for silver solid-state batteries threatens to drive silver into an even more acute shortage in 2026. While paper markets like COMEX dominate trading volume, persistent physical premiums in Shanghai serve as a reality check, suggesting the true cost of owning silver today is increasingly set in the East. I would love to hear your thoughts on this. Are you buying this dip or waiting for more confirmation? Do you think the fundamental case for silver is strong enough to overcome the volatility risks? Drop your perspective in the comments, because the best insights often come from this community's collective experience. The bottom line is this: silver just reset from record highs in spectacular fashion, but the structural forces that drove it there have not disappeared. Industrial demand is accelerating. Supply deficits persist. Eastern buyers continue accumulating physical metal. The question is not whether silver will eventually move higher. The question is whether you can handle the volatility along the way. If you found this analysis valuable and want to stay ahead of these major market moves, make sure you subscribe and turn on notifications. The precious metals market is going to remain volatile throughout 2026, and understanding the real dynamics will be crucial for making informed decisions. I will continue bringing you data-driven analysis that cuts through the noise. As always, this is educational content based on publicly available information and should not be considered personalized financial advice. Always do your own research and consider consulting with a qualified financial advisor before making investment decisions. Markets can move against you, and past performance never guarantees future results.